None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Long weekend. I didn't want to get up this morning. I don't know about you folks, but although the markets are actually moving today, so there was one day last week, what was it, Wednesday, that it literally didn't go anywhere all day. That's pretty amazing.
Yeah, it just stayed right there, didn't do anything.
So I started to find a copy of the Summertime Blues, old 60s song, and put that on this morning. That's pretty much what we're dealing with here. Although we are seeing some movement, and most of what we're seeing here is just a reaction to, I guess, really profit-taking. Whatever that report was on Thursday we had with the employment coming out, there was a lot of, I guess, a lot of positive stats, if you will.
Yep.
But, you know, it's just, it was the day everybody waited for, and we closed early. Everything was there. So just a quick announcement before we get going on today's show is we are getting so many emails that all you guys are on vacation, which we are not for some reason. What's going on with that, Mitch? I mean, why are we working? I don't know. We closed the shop down for the summer, right? And
right.
But we're going to try to just for now go on to some what we're going to call summer
hours.
Yeah, summer hours. Thank you, Mitch. But summer hours, and we're going to do Monday and Friday for. So we'll start the week off, kind of talk about what's going to happen, and then at the end of the week we'll do I guess a synopsis of what has happened, and maybe looking forward to the next week. But we're just going to do Market Thunder. We're going to suspend the Process Warriors for right now until probably September, and then we'll get back on full schedule, and we're probably going to be doing some special segments over the summer, but it'll be announced and you'll know, and if you can always stream it in case you're not there. So there is literally, Mitch and I were talking before we came on air, there's nothing going on. 0.0. I mean, if you look at the news this week, other than earnings start this week, tomorrow we get Alcoa. But other than that, I mean, you're really looking at thank God for earnings, I guess, right? Because the economics this week is just pretty light overall. So anyway, I guess we'll kick it off since we're seeing some downside here. We'll go ahead. I don't know. You got anything, Mitch, at all?
No, let's start crunching through the markets.
All right, let's do it. Okay. So as we're looking at the markets here. Let's bring up, I'm going to go ahead and switch this over to a daily graph here. And I've kind of got myself positioned, so I'm right in the way of the numbers here. And bear with me for a second. I will move me out of the way so I can do that. So there, I'm going to slide over just a little bit. And so we're seeing the market traded down. If you looked at the daily numbers today, the extreme number was 1975.40. The low today's been 1975.20, and we're bouncing a little bit here. We're 77.61. still down 0.40 on the day, so not a lot going on. The pattern, as I talked about in commentary, there's a good possibility for at least 2 more sessions up. The fact that we took out the 1980, let's see here, 1980.45 today tells us we're going to end up most likely closing down on the day. That slants the odds by taking that number out. So it's pretty obvious, I guess. It looks like we're going to close down unless there's some big turnaround. With no news coming out. I think there is one of the presidents of one of the Fed is talking today, but it's like I said, most everybody's on vacation, so there's not a lot to. I'm not sure who's watching anything right now. So anyway, but the result of this is that the patterns are continued to unfold. We actually started to build some upward momentum in the last several days, which has all been lost this morning. The PPMs are about as boring as the markets, or as flat as the markets. PPM 1 on the daily 0.07, and then 0.09, and 0.13. All three of them below trend level, so there's not any uptrend at all. And in fact, it's a little vulnerable to. We bring up some numbers here to some penetration here if the market closes down. So the numbers on the downside are going to be here. Possibility of trading down toward probably 1970, maybe 66 level over the next 2 days. If we close down, we're going to need to close below that 1980.45, and we're currently, like I said, we're at 77.53. So if that starts to I guess if we can close above that, then that'll give us some more sideways movement than down. If we close below it, then that'll tell us we'll probably get at least one more day down. I don't see a lot of downside below the 66 number. We could go as low as 56, but that's pretty minimal from a probability standpoint. But there are no trends on the short term right now. We're just flat. We're going to have to go to the intermediate, which I'll bring up now. Intermediate charts, we came pretty close to getting up toward this second target. I talked for weeks, and now it's kind of off the sheets, but the 1973 level, we were able to penetrate through that. We actually hit a high. Let me just bring this stuff up here so we can all see it. I put it over on my left shoulder here. We've got a high of 80. Let's see, the high was 85.59. Is that the actual high? 80. I believe that was the high that we've been. So we're a little short of getting up into the 90s level. And one of the things I talked about last week, one of the possibilities is that we're going to do the same thing that we did at 16, 17, 18, now 1900, now 2000. Every 100 points, we've reached that level, and then we start to get some volatility, and we've seen a retracement. Whether we get, there's a target that I had at 2003, 2013 on the daily graph, and that is likely to be hit, and maybe that's where we start to see the same pattern that is unfolded every 100 points as we went up. Let me get off the screen here so I can look at some of these numbers. And the bottom line is, you're looking at PPM. This number is actually off a little bit. We've got up to about PPM 1 on the weekly is at 0.50, 0.34, and 0.38. So we are still expanding on this trend, even though we're seeing some downside today. And this is actually calculated recalculated by every tick. So it's there's not anything. I guess it's all considered with what today's action is, so we don't have to wait till the close to see what those numbers are doing. So we are seeing some drop down in the PPMs. If you notice over here on the right hand side of the screen, you see PPM 1, 2, and 3. All three of them have rolled over a little bit, but the overall trends are still there. So what you'll see a lot of times once you get into this phase of a trend is that the PPMs just kind of go sideways. They just need to maintain over 0.25 to keep a trend involved, keep the trend unfolding. and the market's generally up from there. Last level here, we'll go over to the monthly chart. And I always talk about this being a super slow motion because it takes so long for this, but we have a new monthly bar going, and I don't think we posted this stuff, Mitch, but I did put out, I ran the monthly bars for the objectives or the ranges for the month. And the extreme, or not the extreme, but the support 1 on the monthly graph, support 1 on the monthly graph is 1944.55, and that would probably be a pretty extreme number if it were to get there. The second S2 is 1927. Don't see us getting there. On the upside, we've already exceeded R1, which is 1975, and then we've got R2 is 93, and then 2011, 2026, and these numbers are all coincide with the Fibonacci projection numbers off the patterns that are being generated off of the weekly and daily numbers. So daily we have 2003 to 13, the monthly objectives is 11, so that comes into that range, 2011, and then on the weekly we have 2034, 2072. So it's a little bit above that number, but they're all kind of in that cluster. So there seems to be a lot of things still pushing towards that. And nice thing is, I love down Mondays when we have buy signals. These are great opportunity to get in the market here and to be able to participate and get some of these going. And we're going to go through in a few minutes, as we always do on Monday. Mitch will go through and walk us through the breakdown of all the orders and things that happen, and kind of look at anything that stands out from the orders, whether it's buy or sell. And but the monthly graph is continuing. I talked about this last week, and there is something that we're finally starting to see a little bit. We're seeing the PPM1 at 161. PPM2 160 and 108 on PPM3, and the PPM1 and 3, which means the 10-month moving average and 21-month moving averages, are moving at the same pace. Which, the first sign, if you recall, if you've been watching the show on a regular basis, the first sign that you start to see when the market gets near a top is that you'll see the slower moving average, or the 10-month moving average, starts to slow down, and the 21 will gain on it. So when this drops, it would have to drop under 1%. This is 1.61% per week, per month right now. It drops down below 1%, and the PPM2 stays up at some level above that. Then we'll see a convergence of the 10 and 21, and that's how the first sign that we're starting to get at the end of this trend. And there's a couple things I can talk about today that I think would be of interest, I believe. I'm going to, I got a couple things I need to enable here just so we can, I want to drag this thing around a little bit so we can get a better view of this screen. And I want to bring out the whiteboard. And this is something I did not bring up in commentary, and but I think it's something. I guess it's what's on everybody's mind. When is this thing going to end? We've seen a lot of buying, and from a VPM standpoint, we'll go through that in a minute. But there appears to be an end in sight. I'm just going to map out this trend here, and this whole last arrow I'm putting up, going up to the right. This has all been one sequence, and there's been a little minor sequence that's happened here, but for the most part, this is all one sequence. And this is also, I would say, without a doubt, a wave 3 pattern. And so what we should see, and I'm going to draw this in, is we should start to see some sort of corrective phase come in. I think there's still more. I think we get up toward these higher end of these levels I was talking about, the 2072. And then after that, if you recall, I think it was 2 weeks ago, I talked about these crazy objectives like 2100, 2200. on the S&P, and this is most likely what could happen here is we get a corrective phase, which could get us into a sideways mode. And during these sideways modes, especially at these levels, what you're going to see in the market most likely is a rotation of what stocks are participating. On an index basis, you'll just go stagnant on your strategies. You're just not going to be able to make any money, but you're not going to lose any money in the pattern. It'll just go into a choppy range. And then ultimately, the stocks, you see a rotation in the stocks. And that's what I'll be looking for, what kind of rotation we get. We have moved up to the 70% level on the bullish percent on the database. So we've gotten pretty robust. Typically we get up to about 68 to 72%, and we're there. So we're about as far as this database is going to go. I don't think there's much that's going to trigger it to go any further than it already has, to be honest with you. I don't think you're going to see any further expansion from the bullish percent standpoint. But then what happens is once some of these stocks start to play out, some of these new buys are going to work, some are not. We'll just have to see how the rotation starts to play out and who ends up leading us the way to the final top. And like I said, still the objectives are 2034 to 2072. Not a lot from here. I believe that's about 3 to 4.5, maybe 5% maximum is going to put us at 2072. I usually have the numbers figured out. I didn't this morning, but that's roughly where we're going to end up as far as that goes. So, but this is the pattern that I've drawn on here that is most likely going to end up playing out. You can see, actually, if we go back and let's over to the left here. So yeah, I'm out of the way. You can see this same pattern, a similar pattern that took us up to the 2007 and 8 highs, and now with this expansion we've seen now, it's pretty big. Possibly, if we get bored on Friday, I will bring up some concepts and ideas on what might actually put us into the very frothy state of the final high. I've been working on some scenarios over the weekend that I thought were interesting from a standpoint, and everybody's talking about the bond bubble. I'll bring that in at the end of the week as we get going. But these patterns that I have on the screen right now, this is typically how they go. The pattern we're in right now is way stronger than the one that we had in 07, and the characteristics are going to be very different. This party will not end like 07 did. And so most likely this, what I've scratched out on the screen here on the far right hand side at the top, is how this pattern will end up playing out. And by the way, this is a monthly graph, so to get that many bars to do that, we're talking about once we do get a top somewhere around this 20, let's say 2034 to 2072 range, once we get into that range, then that's going to be the top of this, and we're looking at, once that's established, the potential for anywhere from 12, maybe 12 months or more before there'll be enough bars to get this going. It could even be further, where we get into a sideways range, and the downward pattern could end up finally getting our, once we get to that stage, we maybe will see our 10% correction, but I don't think we see the market roll over the final. And I must I guess start to set up this scenario as that this next sequence, when we do get up to if we do this scenario I've got on the screen, that final arrow going up will be the end of this long rally, and not just this rally, but going back 50 years or so, 50, 70 years. We're coming into a really big top ultimately, and it still could be a couple years out before this thing plays out. But there's some big patterns that I'm unfolding that it's funny is there's a detour sign, and I think there's a cliff at the end if you don't stop. So we'll find that out. But we'll start developing some of the thoughts around that. For right now, foot's on the gas going on, even though we're seeing a little back up this morning. Real quick, let's see here, before we get Mitch back on the screen here, and we start going through some of the gyrations of the markets here. What I want to do is bring up the treasuries our favorite Treasury index, and we're looking at the Treasuries have moved back. As a matter of fact, let me get this off of here real quick here. Take the models off. But this Treasury index, we've moved back to 261. We were at 263 today, and that was back into that 265 resistance that I'm talking about. It's actually, the range is 265 to 268. Once we get above that area, which it appears we're going to try to get above, then we'll start to move higher. And of course, the magic number on the Treasuries, everybody knows, is 303. If you didn't know that, you do now. So we'll go ahead and but the trends have turned substantially. We're actually a positive. The PPM, if we just go back just a couple weeks ago, it was minus 111. It is now plus 10. So that the 10-week moving average has made a complete about face where it's actually turned up. The 21 and the 40 are still down, but the 40 is flat and the 21 is still down a little bit, and that's generating the pressure. So it's probably going to take another week or so this week. Maybe by the end of next week, we're going to be in position to start to see these rates move up a little bit. And as I've talked about, I do not see them affecting the overall market from the standpoint of the trend on the market. So we could get, depending on how this week plays out, we could get a week or two of sideways on the market and then start to see us move up. But like I said, patterns I'm going to be watching for as we go through this week. The pattern I'm going to be watching for is really looking for the market getting up towards that 2,000 level and see if we're going to get the same old action that we've got over. And I'll be probably talking about that over and over again until we see what happens. So let me bring Mitch back in here. That was kind of interesting. I did have a screen with both of us on, and now I don't see him.
You just wiped me out. You don't want me around.
I did, I guess. Huh? Bear with me 1 second here. Yeah, it's really. Oh, there it is. Yeah, it was me, not you.
I'd say so. I didn't do anything on my end. So.
I know. So anyway.
Yeah, blame me on that one.
So yeah, let me. I'm not sure I logged into.
That's all right. I could log in.
2:0. Let's see. It should be live. I'll let you drive. So let me. Before you do that, go ahead.
Sure.
No, go ahead. I got it. I got the other screen here. I'm going to bring Mitch up by himself just so he can talk about what's going on here.
And let me log into the system. Got timed out here, so bear with us 1 second. All right, one of the things I actually wanted to start off with today was actually showing you a few different things on the commentary for today that jumped out to me. First off, year-to-date performance. I thought this was interesting. I double-checked the numbers right at the very beginning because it didn't look right when I was putting the data together last week. So we see this massive surge in the NASDAQ. So right now the NASDAQ, the S&P 500, within 0.01% as of last week's close. This lines up with a lot of the buying that we saw within the database, especially on the technology and healthcare side. We'll show you that in a second. Going down the list here, you see the S&P 500 pacing. Every now and then someone asks, well, what does this chart represent? This chart is a bar chart. So it counts up the number of companies within the S&P 500 at each of the different percentages. So it shows you the breadth of range of the S&P 500, the individual companies. So you see the worst performer right now is down 38%. The best performer is 82%. Now that we have this advanced charting, one of the things that we're going to be adding in conjunction with the week-by-week trades that we go through, we're going to also break this down so you actually can click on one of these little data points and see what that company is. So that's going to be coming soon. Part of the joys about taking or going to these summer hours is it gives us more development time to work on this data to put out for when we do have these Market Thunder broadcasts. Another thing that I thought was pretty interesting last week, we put out this data. Bob mentioned the monthly numbers. We've talked about doing this in the past and how to best display this. One of the things that we do put out right now are the weekly numbers. And if you look down here beneath the chart that shows the day-by-day activity for the prior week, we also have the activity as it relates to the weekly levels. And when you click on that, it brings up a light box of the chart. And you see that really once we got up to the resistance 2 level, we pretty much stayed right there. You see on Wednesday, we really hugged the line on the resistance 2 level. And finally Thursday with that low volume, we were able to break through resistance 2. Also, we were able to break through resistance 3. And it was, I thought it was pretty interesting that right as we came into the close, it looked like we were going to settle right at resistance 3 before the final short covering of the session put us up a little bit higher, closing at the high of the day and the week, for that matter. So those charts are available to you. When it comes to these levels that we talk about, both in Market Thunder as well as in the commentary, you're going to find those at the very bottom of this commentary page, where we show you the daily ranges as well as those weekly ranges as well, down here at the bottom. So here the table to the left shows you these weekly levels. So here are the levels that Bob was talking about earlier today, both on the daily as well as the weekly side.
You know, Mitch, I was just looking. Go back to those numbers real quick here. I thought that the.
It's like we're both trying to steer here. Why don't you take
no,
that?
I don't have anything. It's all
Okay.
you. It's all you. Anyway, yeah. So well, maybe I better grab it since you're not doing a very good job here. Anyway, one of the levels I just wanted to bring out is typically what we see is, if you look at all these levels, even on a daily basis, you're going to see that we get, matter of fact, I'm going to get us out of the way so these numbers are clear on the screen here. But these numbers, if you look at them, typically we'll see even the S1, if it's an up day, we'll see an S1 support not being breached. If it's a kind of a neutral day, it'll literally trade between, on a daily basis, between S2 and R2. And then on the stronger or weaker days, it'll trade down toward the extreme, which on the daily today, we went all the way to the extreme, 87.80. We never got to that level. It basically opened, the cash index always, for the most part, unless it's a very weak or strong opening, starts at the same price it finished on Friday because of the way it's calculated. But the bottom line is, on a weekly basis then, S1 1978, we've been through that, and S2 is 1971.50. So this actually coincides with the numbers I was talking about in the index review of that S2. We get down to 1970, and then the extreme, I said 1966. From a Fibonacci relation standpoint, this 1964.10 is the number that we could go to, which would be S3. And then the same thing on the upside, R2 is 99.45, and then R3 2006.80, and then there's, like I said, all these clusters. But these numbers are there for your review and track if you're doing things. I know for the most part, a lot of this stuff doesn't really matter, I guess, or bring us back up. Doesn't really matter from using VPM. If you're following the indexes and you're really following things closely, then there may be some benefit here. I guess I always think people follow this thing like I do, which is, that's what I guess you pay me to do, right? So that's why we're doing what we're doing. So anyway, but yeah, Mitch, why don't you go ahead and take back over and go through some of the other numbers. Sorry, just wanted to intervene there and mess up your flow.
No, that's good. And so I just wanted to make sure that people know that information's there. I wanted to explain that a little bit more. Let's jump back over on the dashboard here. We'll go through the activity for this week. So looking at the stocks, you see we had broad buying again. I pretty much had buying across the board with the exception of utilities, which saw just a slight exit on it. There really isn't much to say on this other than we keep slowly adding more and more positions across the board on the stock side. This week we had 1,000 new buys across the board, and this is pretty much even between both stocks as well as mutual funds. Jumping over to the mutual fund side of things, it did catch my attention when you look at the high level view of the funds. Really, the selling that we saw this week was really in the muni bond space. So when we click on that, we can see the breakdown here, and you see that we really had the most activity on the exit side in these muni bonds. So it looks like it's been about a year since we've took on these positions. Last summer, about this time, we were almost completely, if not completely, out of all the muni bond space. And now it looks like we're starting to see some of these trends end on some of these bonds, which makes sense given the average duration on a lot of these bond positions. That we're starting to see some gains being captured on these, and then moving back to a more defensive position when it comes to the bond space.
You know, you stole my line. I was just going to point that out, because when you start to get to these average durations, you're going to see some of these things roll over. They become somewhat sensitive, and these numbers, if you watch your durations and your objectives as far as the returns, you'll see that they're amazingly accurate on how they unfold. So anyway.
Yep. On the equity side, we saw some more buying across the board. Pretty much what you're going to we saw the most buying, though, was on this growth side, both in the large cap growth as well as the small growth. But even some of the value positions were added last week. We really didn't see that much selling to speak of. So it goes back to the story that we keep ramping up the equity exposure across the board, both in individual equities as well as these more index-based assets of these funds or ETFs. We're seeing the same type of activity as they're catching up, as these compilations of these stocks are finally starting to go long and trend together. We're seeing the activity as well, and now we're starting to see the small cap catch up on the investment exposure like the large cap has been for quite some time now. On the weekly research, there isn't much to say here. Of the various different ETFs that are on this composite, there really hasn't been much new activity. We did get a question last week. We didn't get a chance to touch upon it about the sale in EFA. One advisor was asking why it was that we were selling out of EFA after they paid out a dividend. Looked like they had paid out a dividend back on Wednesday of the prior week of around $1.68. Bob, did you want to make any comments about that before I dig into that?
No, because I hadn't reviewed it. But
okay.
No, I mean, it's interesting because there has been. I mean, as you bring up, can we go back to on this chart here and look at? Is this last week's activity in Europe?
This is year to date. I mean, we could easily pull up. So here's last week right there.
Yeah. So it's refreshing right now.
Yep.
But anyway, yeah, I think from the standpoint of what's going on there, is you are seeing some downward pressure. I mean, there's still let me come on screen. There's still some things going on in Europe that everybody wants to think everything's fine and moving forward, but there's still some things going on in Europe. And I did see the pattern break down, and basically we just did a rebalance on that portfolio, because we had I think EEM on Global Equity 4 we had a rebalance, so we kind of removed rebalanced the entire portfolio. And let's talk about really what's going on here is really the portfolio dynamics, right? And those dynamics are that while we rebalanced the risk, and then one of the items inside that list the following week became a sale. And so two things happen. And from a portfolio construction standpoint, you're playing portfolio manager. You get the virtual manager here, and the virtual manager rebalanced the risk one week and then took some risk off this week. So we're seeing an 80-20 portfolio. That's still, I mean, the beta is pretty much probably 1 or less. If you're going against the S&P, it's probably a little less. So you're not going to fully participate on the upside, but it's not supposed to. It's a global strategy. It's not a domestic strategy. So that's how that should work. So really what you're seeing is a dynamics from a portfolio construction standpoint is that if you were sitting on a mutual fund trading floor and you were running some fund, there was a decision basically made to rebalance, and then the following week to take off some risk. And that's what's going on. That's what managers get paid to do, and that's what you're seeing. You're at the Jimmy Dean sausage factory. So you've got you're seeing all the movements of this stuff from a quantitative standpoint. And I guess when a question like that comes up, Mitch, it's sort of like, what's the logic behind it? Well, there isn't any. It's not logical. It's quantitative. And so when you see that and you see price movement, VPM is going to respond to those type of movements, and that's what it's supposed to do. So like I said, if you go back 3 weeks ago, we had the rebalance and then taking off EFA off of that. And it's interesting because I didn't show this chart today. I'm going to grab I'm going to take us off screen, and since I'm getting deep in there right now, but let me bring up. This is one thing that I did not bring up, as this is the international spread charts I'm talking about, and here is EFA. EFA is drastically underperforming the U.S. market. I didn't talk about that, and that surge in the last couple of weeks here. This is a let's see, what is this, a weekly graph? Let me make sure it is. It is weekly. So this is what we're seeing at EFA, and it's interesting because the emerging has not been as weak, but the EFA has been. So overall, we've taken off a weaker component off of there. So long answers, and Mitch knows you have to be careful what you ask me, because it could end up to be a big answer. There we go, Mitch. You're back and driving again. So
one of the other things I wanted to add about this trade, when you account for the dividend that was paid out on EFA, we made the sale after the dividend, so that the total return, this trade probably made around 4 or 5% when all things are considered, after the price return as well as the dividend paid out.
Does that show up on the trade impact chart?
Well, the trade impact chart will just show the price return, but
right.
But yeah, the new sale that took place, you should be able to see it here. Let's pull this up, because it was as of the 30th. I have to double check, make sure it's showing the last sale on this. But anyway, this market really has been lackluster for this year. It isn't showing this trade because this is showing all the data as of the close here. So I'll have to double check that, see why it's not showing up.
But doesn't this get updated once a month, right?
Yeah, it gets updated monthly. So I got to see how exactly
how it hit.
How it hit.
Yeah.
But in this case, we've really been lackluster on this for the better part of this year. On a price return, this ticker's up about 2.25%, and that's all that we've participated in. So it's the trends really haven't gone anywhere. This distribution finally pushed it down just a little bit lower. So I think this is really a great trade because all the points that you mentioned when it comes to the portfolio management side of it. Also the fact that we were able to capture out a fairly nice dividend payout on this, and then to take that capital preservation mindset on the portfolio as a whole.
Right.
But I just wanted to touch upon it in this broadcast since we had the chance.
Okay.
Lastly, Globe at a glance. Taking a look at last week. Really, it was a pretty quiet week last week. I was looking at it, and I think the largest gain across the board was about 2%, and I think it might have been in Turkey or something like that. That may have been the week prior. But again, I just encourage you to take a look at these charts. You could see how our own activity is shaped up versus other activity across the board, and you can see how it is that we're performing versus other countries when it comes to the global economy that we live in. So I just want to make sure that advisors know that that's there. And I guess that's enough of that for today. Jumping over to the 2.0 system, I just want to show the rotation. We talked about this in both commentary as well as earlier in today's conversation. But if we go to the research side of the site and the all stats page, we can take a look at some of the activity that took place this last week. So as Bob mentioned earlier, we're now at 70.51% exposure when it comes to the overall symbols of the database. We talked about in last week's broadcast about how we've done the optimization on the trade system. So it's now almost completely 50-50 between the 1.2 and the 3.2 trade systems. And then as we were talking about earlier, we had 1,000 new buys this week between the 1.2 and the 3.2. We sold off 300 positions. So it's overall a bullish uptick when it comes to the database. and all that is shown within our charts as well. So thank you, Bob. There's the 50-50 I was trying to get to earlier.
Oh, yeah.
So there you go. On the 1.2 weekly, we have 49.9%, and on 3.2, 50.09%. It's about as close as you can get between a 50-50 split across the database.
All righty. So that pretty much covers all this stuff, right?
Yep. Yeah, we're good with that.
Okay. So Mitch and I both back on the screen. I was trying to adjust the sizes of our picture. Now I'm much bigger than him. That didn't mean that to happen. But it's because I'm closer. That's what I did. So if I lean back, see, now we're the right size. Anyway, overall the rotation we're seeing here is going to be somewhat methodical. You're going to see these types of rotation happen as these trends evolved. I guess maybe from watching this portfolios move, there's some expectation that, well, the market's it shouldn't be doing anything, and it is. It's not about always having, well, why did it do that? Well, it had a lot to do with the whole activity of the individual symbol on the EFA. But all of these strategies, whether it's individual stocks or whatever it is going to have this same type of characteristics. You're going to see these little incremental moves, and it's only when the big, ugly moves happen or exciting moves where you can see big tranches of orders going in or coming out of the market. So I think there's I think it was 3 weeks ago we had like 3,000 new orders come in.
Right.
I don't remember what the net was, but anyway, it was. The point is that you're going to get these big tranches and happen around the next breakout level of this trend, and so we're seeing this rotation, and that's where rebalancing happened. And then you're going to see at these levels, folks, you're going to see trades come on that some of these new trades just aren't going to work, and some are going to work really well. Probably the ones you don't think will work, and the ones that you expect to work won't. And that's just the way that goes, because it's just what you're going to see is this rotation, and once you get in these high levels and you start to see markets moving up. I was looking at some of the trades that happened in a couple of my portfolios this weekend, and there's a couple of trades that are coming in at high level, and they're high level breakouts. I call them Jim Cramer trades. You buy high, sell higher, and those do work, and they only work in the environment we're in right now when you have a robust trend that's going on. And so if you look back at what we talked about earlier, is we've got the long-term and intermediate-term trends are still very, very positive. So I guess we'll probably have a little time to get into some stocks here. Let me bring the screen back here. And see, I'll go ahead and go this alone here. So Mitch is he's got a list of stocks, and we're going to highlight one I know we talked about earlier, if I can get to the right screen here. I can't find the right screen. Excuse me 1 second here, folks. That'll help it right there. Okay, so first one was what? USX, US Steel, right?
US Steel, ticker's X.
Yeah, I know that one real well. One of my old mentors was a big USX guy. We traded a lot of this stuff over the years. But yeah, so this thing came out of the Dow Jones, right?
Out of the S&P.
Or the S&P. Oh, not the Dow Jones. Yeah, I thought it was the Dow Jones, but
no,
I thought it was more exciting than that.
I'm sorry.
Yeah, so the S&P, so it's fallen off the capitalization. And this is a steel company that spun off, that bought Marathon Oil once upon a time, was a steel and oil company. Then they spun off Marathon, I think, many, many years ago. So this is all steel. And remember the steel boom a few years back. Let me consolidate this a little bit. Here's that big ramp up. This is the 08 high, but matter of fact, let me go to monthly here just so we can see the really long-term trend in this thing. You want to see a spike? Here's a spike. Let me spread this out just a little bit. So this stock went all the way to $1.80 and now to 27. So so much for China and India buying all the steel on the planet. Remember, that was the scenario back in the '04 to '07. We used to have in the premieres, I had a bunch of indexes. I put the steel index, and I had a bunch of different industry type groups, biotechs, and those type of things. We cleaned that up several years ago. But if you just had that steel index, it was up 100 and it was a crazy number, like 125 or 140% in that during that period in '07 when you see that spike. Everybody was buying the steels. It didn't matter who it was. All the that was the big boom that everybody finally realized that everybody was moving from the country into the cities in China, and off they went, and they were going to buy all the steel on the planet forever and ever and ever. And we found out they didn't. And then you see, of course, in the '08 crisis, you can see what happened to the prices there. It was just a complete collapse. And I guess let's use this as an example. I can go on about this a little bit because there's some interesting things that are coming up the screen here. Because what we can use this for is this. These are kind of I'm drawing the arrows on here. I'm going to draw little arrows, and this is, by the way, a classic 5-wave up pattern ending. And you can see when it ended, boy, did it end. It was a straight down collapse. Similar to 1987. I don't think anyone on this broadcast knew me then. I used to have an old customer that was with us. He passed away several years ago. He did know me then. But one of the things I talked about in the September of 1987, that the market had reached this wave 5 of 5, and that we were very close to an end. And we saw a collapse, of course, of 40% in 3 days, which was pretty phenomenal to live through. If those of you who've been around saw that and understood it from a market perspective, and trying to be a professional in this environment, was a very interesting time. But when these 5 waves end, when you get to 5 of 5 of 5, this is the way they finish. When I was talking about the indexes earlier, ultimately, I don't know if we end up with this particular pattern, but when it's over, they never end pretty. They just don't end pretty. And the fact that I think Mitch was saying something about before air that we had somebody was saying why the Dow's going to drop to 15,000 and all that kind of stuff. As long as those guys are around, it ain't going to happen. Okay, so and matter of fact, I had CNBC on early this morning, and I saw some guy talking about this has got to be the rally with the most pessimistic viewpoint on the rally. Like, no one believes it, but meanwhile it's still going up. So they're talking about all the people that haven't bought the market. Well, somebody's buying it, and it's obviously all about the Fed. And I've been working on something in the background that I think is going to be it will be interesting as we start to talk about what the end might look like. Let's just say how's this party going to end? What's going to trigger it? I've run into some things in reading and research this over the last weekend that really has piqued my interest, in which I will bring to you once I've got it to the point of being able to discuss it. But yeah, so this chart ended, and now what we've got. But this is actually interesting now, because what we're getting here is this consolidation. We have a complete convergence on a long-term basis. Let's go back to closer to reality and get to the weekly trends. Mitch, what model is on this thing?
Give me 1 second. It is 1.2 weekly. We actually got a brand new buy on X today.
It's funny. I was going to say this thing looks like it's ready to buy. I wish I'd have said that before I put it up, and before you said that.
Sorry.
That's all right. Yeah, so we got a new buy. This stock looks like, to me, it's tried this before. If you look at this pattern, let me bring up the whiteboard here real quick, because it's more of a educational section here than anything else. the patterns that we've seen, this one looks like about a break even, a little trade. I don't see the buy in here for some reason. It's in there. I just don't see it. We've got another buy and sell here. Now we got this new buy. And this is almost like the Japanese yen trade that I've been talking about. We get this big, long basing period on this stock. And maybe you start to retrace back to some of these old highs. And of course, this stock was way up at 180 at one stage. So it's got a lot to rebound if it decided to do a rebound back toward the old highs. I mean, if you think about it, and we haven't really covered the NASDAQ at all when we go to the indices. We need to maybe make a note, Mitch, that we should talk about the NASDAQ on Friday when we do the show on Friday. But, I never thought we'd see 5,000 on NASDAQ again. We're 4,400 and change, so we're a lot closer to 5,000 I thought we'd ever be. I mean, for years we did this base like this, and if you look at that, that's what happened. But anyway, but this is really a long basing period. In this case, it looks like maybe the fourth trade's the trick. Maybe we'll see. But these are the kind of bases that you want to be involved in, I guess. So maybe there is that would tell me if that's going to happen. So I always do this reverse fundamentals, right? So if U.S. Steel's stock is going to go up, we'd have to look at some of the other stocks to see if it's not a company-specific thing. But maybe look at see if you can find a steel index there, Mitch, while we're on the steels here. But the bottom line is, if there's going to be an expansion in steel, guess what that means? That means there's going to be an expansion in the economy. And one of the things that folks, because we are the New World Order has been driving the markets, George Soros and all those guys trying to get everybody to be one planet. I think John Lennon started it, didn't he? No countries, no boundaries, no religion, no whatever. So they're trying to push us to the John Lennon version of the planet, I guess.
I guess.
Yeah. So but what we're seeing here is, did you find an index there?
SLX. There's a steel index ETF. We're actually long it on the 3.2 system.
All right. So let's SLX.
You got it.
Didn't expect to get down this rabbit trail this far, but and you said it's 3.2?
Yes.
And we've been long it for a while here.
Yep. We got in on the SLX about the same time we got in on U.S. Steel on the 3.2. Obviously, U.S. Steel has been optimized on the 1.2.
Yeah.
But because of the optimizations, the shorter time period for this ticker to have been around, the ETF that is,
right.
It is currently mapped to the 3.2 system.
Okay. Yeah, so this is that same basing pattern now. The big spike, as a matter of fact, if we go, let me go over one more level. The model may not matter. But yeah, you can see, I'm kind of in the way, but you can see the basic chart. Let me expand this out a little bit. You can see this big spike, just like we talked about in 08, and it dropped from 110 down to, let's see, what's this value here, down to 20. So that's a pretty good sized drop, huh? About 75%, maybe almost 80%. So that's a big drop, and now we've seen this big consolidation. And these are giant trends that happen inside of these industries and inside of this stuff. So, and once you start to get into, let me just see if I can consolidate this back a little bit. I'm just trying to get it back, and yeah, I guess I did manage to get back there. But you can start to see on a weekly trend here. You can see we've had a couple good trades, and then we got in this choppy mode, and now we've had this trade that's been on for a while. What's the net gain on that? Can you see, Mitch, real quick?
22%.
Okay.
Let me pull it back up.
And this is on the SLX, correct?
On SLX,
yeah. So
22.6%.
Well, you're looking at these things, playing some of these industries, and these turnarounds are pretty good. We haven't spent a lot of time looking at that, but we do have kind of a dynamic premier sector that you can look
We do.
at. That's out there as well. Of course, we have fact sheets on them, all that good stuff. Anyway, yeah. So
And I think you've said this before, but I think the steel index is a great thumb in the eye on any buy and hold advocate, because you could just see the significant correction that's taken place in this overall
Oh, yeah.
industry
Yeah.
over the years.
yeah. So I guess even if this index only goes back. It looks like to 07, at least on this graph I got here. But the bottom line is, if buy and holding's not going to do a lot, especially and when I first started the whole VPM project was way back in 1994 actually, and I was trading using TradeStation, which you're saying here. I was using pretty much 1-2 for the most part, some 3-2, but 1-2 for the most part on the Fidelity Select indexes, and I was actually generating about there was a point in time where I think for 4 years it was about a compounded rate of return close to 15. It was pretty impressive.
That's pretty good.
That's what kicked off. I was doing it manually. That's what kicked off the actual very first process that was built, which was called VisiPort back in 1995. And 96, I guess, was when that was being started, was based upon those fidelities. And we ran it, I was at a broker-dealer, and we actually distributed it throughout the whole firm. And I also, we did a weekly radio station talking about the strategy. It was pretty impressive. I think it's still out there. I don't know if we have it in the premieres anymore or not. I had old Fidelity Select, but you have to clear Fidelity to be able to use the Select funds. So or you have to be retail. So and my old broker dealer, we were NFS folks, so we were able to do that. Anyway, we got about 3 minutes to go. I think what we're going to do is call it quits on that, and I'm going to go back to charts. I just want to go through index review. We're pushing back down toward the lows here, and there's one of my favorite charts we haven't looked at, which was my 24-hour charts. The cycles have gotten kind of whacked out a little bit, although this one here was a nice low. We're about another let's see here. I can tell you here, we're about 8-9. We're about an hour away from the next low. So if we hold the lows here, we should see a bounce back on the close. Like I said, the critical number at the end of the day is going to be 1980.45. So close back above there would it looks like it wants to get up that way. The hourly cycle came in pretty accurately. Let me bring this up full screen so you can see this. I've got this pulled over right now. It's not letting me go back over anyway, but right here was the cycle low, which was on the low of the day so far. So if this thing continues to hold, look like we'll start to move back up into this range. Probably look for a recovery into the close. And just since we're not doing a show on Wednesday, usually I'm in pretty good shape to do that. So at the end, it looks like I said, the key numbers to watch for, and this will be on commentary. Commentary will continue as always. Will be the 1864 level on a weekly. 71 to 64 is going to be an absolute extreme for the week. I'd be surprised if we get below 71 at all, 71.50. And so look for higher levels, 92 to 99 by the end of the week. So anyway, folks, have a great day. We will see you on Friday. Remember, no Process Warriors tomorrow. So did you have anything in closing, Mitch, that you wanted to say?
No, not today.
Not a thing, huh?
Not
I
a
put you
thing.
back on screen for nothing. Okay.
For nothing.
All right. Well, folks, have a great day. I hope you enjoyed the show, and please send us comments. You can do whatever you need to do to keep us honest. All right. So once again, have a great day, and we shall talk to you soon.